A buyer agreed to purchase a landscaping company doing $2 million a year in revenue. The financials looked solid. The seller had been running the business profitably for years, and then someone ran the actual numbers, not the revenue, not the accounting profit, but the one ratio that tells you whether the business can actually survive with debt attached. The deal nearly fell apart weeks before closing. Revenue did not cause the problem. Revenue looked fine. The problem was that nobody had seriously asked whether the cash the business generated was enough to cover the loan payment every month and still leave something in the account. That question has a name. It is called debt service coverage ratio, and it matters more to a lender and more to a buyer who wants to stay solvent than any revenue figure on a listing page. There are 5 numbers behind every acquisition loan decision. Revenue is only the first one. By the end of this video, you will know exactly what lenders are actually measuring and why a business that looks healthy on the surface can still put a buyer in a very difficult position. Welcome to Main Street Ledger. I'm Kurt Rose, CPA, former CFO of an SBA lender and entrepreneur. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources and experience. If this is your first time here, subscribe below. This is education, not financial, legal, or investment advice. Most first-time buyers find a business the same way they find a house. They filter by size. A $2 million revenue business sounds substantial. It sounds like something that can support a family, carry debt, and still have room to breathe. What they do not realize is that lenders are not looking at that number at all. The moment a lender opens the file, they move past revenue almost immediately. What they are looking for is something more specific. How much cash does this business actually generate after it pays its normal operating costs? And is that enough to cover the loan payment with room to spare? That gap between what a business earns on paper and what it actually produces in usable cash is where most first-time buyers get surprised. Sometimes the surprise happens early when a lender declines financing that seemed like a certainty. Sometimes it happens late, when a buyer who closed on a deal they were proud of finds themselves 3 months in with no financial cushion, and a loan payment due, regardless of what last month looked like. This applies whether you are financing through an SBA lender or a conventional commercial bank. The math is the same. What differs, and this matters, is how each type of lender responds when the numbers move against you after closing. We will come back to that distinction. Revenue is just the headline. Cash flow pays the bills. The loan creates a new expense. Rate risk changes the math. The cushion tells the story. 5 numbers. Let us walk through each one. Number 1. Revenue is just the headline. When a listing shows $2 million in annual revenue, that number is doing one thing. It is telling you the business has customers and generates sales. That is useful information. It is not the same as telling you the business can survive debt. Revenue is the top of the financial picture. It is what the business earns before anything gets paid. Before rent, before payroll, before supplies, insurance, fuel, and equipment maintenance. By the time you work through those costs, the number that remains may look very different from the headline. A landscaping company doing $2 million in revenue might produce $200,000 in available cash after expenses. Another landscaping company doing $800,000 in revenue, run leaner, might produce the same result. The revenue figure told you nothing useful about which one could support a loan payment. SBA lenders and commercial banks both know this. Their underwriting starts with cash generation, not sales volume. Filtering listings by revenue is sorting by the wrong number. So what is the right number? Number 2, cash flow pays the bills. The number lenders actually start with is what the business produces after normal operating expenses are paid. In acquisition analysis, this is typically expressed as seller's discretionary earnings, what the business generates for the owner before any debt payments are made. Lenders then apply their own adjustments, normalizing for owner compensation, add-backs, and other items. So the final cash flow figure used in underwriting may differ from the SDE shown on the listing. That adjusted number becomes the starting point for everything that follows. In our landscaping example, the business does $2 million in revenue. After all operating costs, it produces $210,000 in available cash. That is the number we work with, not $2 million. Not whatever the tax return shows as net income. This matters because accounting profit and available cash are not the same thing. Depreciation reduces profit on paper without reducing actual cash. Lenders recast the financials to find the real number. Buyers need to do the same before they make an offer. One practical note. For businesses that rely on physical equipment, vehicles, or machinery, ongoing capital expenditure needs can reduce the cash actually available for debt service beyond what the expense line shows. A landscaping company runs trucks and equipment that wear out and need replacement. That reality belongs in the cash flow picture, even at the evaluation stage. Number 3, the loan creates a new expense. Here is the shift that catches most first-time buyers off guard. The seller ran this business for years without a loan payment. The buyer will not have that option. The moment the acquisition closes, the loan payment becomes a fixed recurring cost that does not appear anywhere in the historical financials the buyer reviewed during due diligence. This is the most important mindset shift in this entire video. You are not buying the business the seller operated. You are buying a version of that business with a permanent new expense embedded in the structure from day one. In our scenario, the buyer is financing $810,000 at current rates on a 10-year amortization. That produces a monthly payment of approximately $13,150, or about $157,800 per year. That payment is now part of the business, whether revenue is up, down, or flat. Set those two numbers next to each other. Available cash, $210,000. Annual debt service, $157,800. The business covers the payment. The ratio is 1.33 times. For every dollar of loan payment, the business produces $1.33 in cash. That is serviceable. And as you will see in a moment, it is not far above where many lenders begin to pay close attention. Number 4, rate risk changes the math. SBA 7A loans and many commercial acquisition loans carry variable rates, often tied to the prime rate plus a spread, and adjusting on a quarterly basis or per the loan terms. The payment calculated at closing is not the permanent payment. If rates move, the payment moves. Coverage that looked reasonable at origination can deteriorate without anything changing inside the business at all. This is the part most buyers do not model. They run the numbers at today's rate, they see coverage above the threshold, and they move forward. What they do not ask is what the coverage looks like if rates increase by 1 or 2 points over the next year or two. At that point, the monthly payment rises, annual debt service increases, and the ratio that looked like 1.33 times starts shrinking without a single customer being lost or a single expense increasing. The home buyer analogy holds exactly here. A buyer who stretches to the top of what the bank will approve has a mortgage, a house, and no financial room to absorb anything else. When the roof needs replacing, the payment is still due. A business acquisition finance at the edge of serviceable coverage works the same way. Thin coverage at origination becomes fragile coverage the moment anything moves. Number 5, the cushion tells the story. Debt service coverage ratio is the number that answers the only question that actually matters in acquisition financing. For every dollar this business owes, how many dollars does it produce? A ratio above 1.0 means the business can cover the payment. Many lenders want to see coverage of at least 1.25 times after all underwriting adjustments. And some require more depending on the industry, the deal structure, and the borrower profile. That means our 1.33 times baseline is not far above where lenders start paying close attention. It clears the threshold. It does not provide a wide margin. Now introduce real life. A few commercial customers delay their spring projects. Fuel costs run higher than the prior year. An irrigation system on a large account needs emergency repair. Cash flow drops from $210,000 to $170,000 for the year. In a seasonal service business, this is not a crisis. This is a normal year with a few things going wrong at once. The DSCR falls to 1.08 times. The business is still covering the payment, but there is almost nothing left. One more disruption, one rate adjustment, and the cushion is gone. This is where the difference between SBA financing and conventional commercial lending becomes material. SBA lenders will typically require annual financial updates and monitor ongoing performance, but the SBA program does not carry the same post-closing covenant structure that many commercial banks impose. A conventional commercial lender may include a DSCR covenant in the loan agreement, meaning that if your ratio falls below a specified floor, the bank can declare a technical default even if every payment has been made on time. That is not a hypothetical risk. It is a standard feature of many commercial loan structures. This distinction is one of the reasons buyers need to understand what type of loan they are taking on, not just what the rate and term look like. Whether your lender monitors annually or carries a covenant, a buyer operating at thin coverage is a buyer without options when the business needs them most. Here is what to take away from this. Revenue tells you the business is active. It does not tell you whether it can survive a loan payment. The cash flow number that matters is what the business produces after normal operating expenses and lender adjustments, not the top line and not necessarily the net profit on the tax return. The loan payment is a new fixed cost the seller never carried. You are not buying the seller's business. You are buying a version of it with that payment built into the structure from day one. SBA loans and many commercial acquisition loans carry variable rates. Coverage that passes at closing can erode without any change in business performance. Model the stress case before you sign, not after. Commercial lenders may carry DSCR covenants that can trigger a default even when payments are current. SBA loans do not carry the same structure but require ongoing financial reporting. Know which type of loan you are taking on before you close. Buyers and owners should aim for meaningful cushion above the lender's minimum, not just enough to qualify. Thin coverage at closing means no room to absorb what the business will inevitably deliver. When you evaluate a business, do not ask how much revenue it produces. Ask how much breathing room remains after the debt payment is made and rates have had a chance to move. If this changed how you are thinking about a deal you are looking at, subscribe. There is more where this came from. Research the deal before you fund the deal.